Hey guys, it's Nick, and in this video, I want to talk about what's going on in the oil market and in oil stocks in particular. So it seems there's been some pieces of news that are a little bit positive, a little bit negative. You got Exxon Mobil with their earnings warning. You got OPEC saying that they're going to extend production cuts for even longer. And you have Biden actually buying back some oil for the Strategic Petroleum Reserve. So, what's the net effect of all of these on oil stocks right now and where they might be going? Let's take a look. So, on Monday, you had Saudi Arabia saying that they were going to extend their voluntary reduction of 1 million barrels a day that started this month and continue that into August. And Russia also voluntarily extended a reduction of its oil exports in August by 500,000 barrels a day. And so Brent oil rose a little bit on that news. But on Thursday, oil prices were down again in the morning. And so they say while crude is about 10% lower this year, with China's lackluster economic recovery and higher US and European interest rates weighing on the outlook for demand. The surge in borrowing costs is leading to lower global oil inventories, possibly setting up prices for spikes further down the line. So the higher interest rates for the carrying costs of holding inventories is making companies hold less inventory. So this analyst says the oil balance will likely tighten and so will financial conditions. Persistent recession worries will probably encumber but not prevent oil from marching higher. Well, most analysts have higher oil price targets all year, and oil is actually down. And so, despite reports, the Biden administration buying 3.2 million barrels to refill the SPR, which it will be scheduled somewhere between September 1st and September 30th. The overall level of the SPR saw a 1.46 million barrel drain. And so that, along with the rest of the stockpiles, raised the total draw on U.S. crude stockpiles to almost 3 million barrels. And so that is the 14th straight week of SPR drains. So the blue is the SPR, the green is total oil inventory excluding the SPR. And so the two of them together is the total oil inventory data. So minus 1.4 and minus 1.5 is like minus 3 million barrels. And so 14 weeks of these negative blue lines is draws on the SPR for 14 weeks straight. And you have US refinery utilization rates dropped for a fourth straight week to 91.1% of capacity, the lowest since May. And on a seasonal basis, it's the lowest level seen since the pandemic. And while U.S. crude production is back to cycle highs at 12.4 million barrels per day, rig counts have tumbled to their lowest levels since April 2022. So in green is the rig counts, in blue is the crude oil production. So they dropped from about 630 to about 545. As for gasoline, weekly gasoline implied demand jumped to 9.6 million barrels a day, the highest level since 2021, but that's still well below pre-pandemic levels for this time of the year. And the UAE energy minister said voluntary cuts to oil supply should be enough to balance the market. What was done is adequate for the time being, he said, of those voluntary cuts of Saudi Arabia and Russia. There was no call for a collective effort. And Barron's reports that concerns that demand for energy is weakening were reinforced on Wednesday by data showing China's services sector expanded at the slowest pace in 5 months in June. So these decline in oil prices are starting to hit the oil companies, and we see that with Exxon Mobil. They issued a filing Wednesday warning that second quarter profits fell sharply and they'll come in about 7.8 billion compared with almost 18 billion in the year ago period. And so their earnings will be released on July 28th for the quarter ending June 30th. So if we look at the oil ETF XLE, this is a monthly chart, this is a weekly chart, this is a daily chart. So the monthly chart has been pretty much range bound between 70 and 90 for the last year and a half or so, but it is definitely drifting lower, right? And the weekly chart is already trading below the 50-week exponential moving average, and here it's trading below the 50-day exponential moving average. Let's look at some oil stocks in the XLE, like Exxon Mobil, which was down about 4% on that earnings warning. All right, it looks very similar to XLE because it makes up a large portion of it with Chevron. Exxon's been holding up pretty well, range bound from 120 to 100, but again, that is also drifting down. Chevron, very similar to the Exxon chart, so maybe expect some bad earning surprises from Chevron as well. Right, ConocoPhillips, very similar. Marathon Oil, Occidental, Phillips 66, and Valero. They have very similar charts. One thing to notice though, Occidental is not doing much better than Exxon or Chevron, and yet Warren Buffett continues to buy this up to the tune of, he now owns 25% of it, and he just bought another, I don't know, 2 million shares or so, like a week or two ago at about $57 average. So he continues to like Occidental and maybe some other oil stocks, but really they haven't been doing anything except sliding down for the last year and a half. Right, so back to Exxon. Should you be buying some here? The price tells you what's going on in the market before you actually read about it in the news, and this price has been saying that oil is topping and is probably heading lower, which will see lower prices for Exxon and Chevron and all these guys, most likely, I think. But in the meantime, while this thing did have a nice run up here, all of the money looks like it's been made already. And so while you're waiting for this thing to make a few new highs, maybe to 125 or something like that, the rest of the market has been going up in a bunch of different sectors. Look at something like XLI, the industrials ETF. It owns things like John Deere, Caterpillar, Cummins Engines, UPS, Federal Express, Boeing, that kind of thing. And that has gone from about $82 in mid 2022 to almost new highs here at about $106. So guys, don't get enamored with oil stocks or any kind of sector because they all have their ups and downs. And right now, oil stocks are not doing much of anything except kind of drifting lower. There are other sectors you could be looking at in the meantime, like industrials or something else. There will be a time to get back into oil stocks, maybe some months from now, maybe when there's more bad news out there and the stocks flush down a little bit, kind of bottom out with a lot of bad news already out there, who knows? And with interest rates expected to go up about another half point this year, their yields are not that favorable compared to treasuries now that their stock price has run up so much. So there doesn't look like there are any big catalysts for a run up in oil stocks in the near future. I don't currently own any oil stocks. Maybe I would look to get into them if they fell another, I don't know, 15, 20% or something from here. They might be interesting at that point. Hope you like this one, guys. I'll see you in the next one. Thanks for watching.